There is a man, let's call him David, sitting at his kitchen table in Coventry on a Tuesday morning. He has just opened the letter from his pension provider, £500,000. His wife is in the next room. He does not shout. He just sits there quietly and thinks, "That's it, we've done it." And in a way he is right. That is a serious sum of money. Most people never get there. He should feel proud. But here is what no one told David. In 2026, the state pension has risen again under the triple lock. It now sits at just over £13,000 a year. The personal allowance, the amount you can earn before you pay any income tax, is still frozen at £12,570. It has not moved in years. So by the time David's state pension arrives, it has already eaten through nearly all of his tax-free income. Every pound he pulls out of that pension pot lands in taxable territory from the very first pound. The financial industry loves to celebrate £500,000. It gets called a milestone, a finish line. What they do not tend to mention is that the way most advisors suggest drawing it down, taking a regular income, maybe aiming for £40,000 a year to live comfortably, can quietly push you into the 40% higher rate tax band before you've even noticed. And there is something else, something most people only find out when it is far too late. If you spend that money in the wrong way, even legitimately, even on yourself, your local council may treat it as a deliberate attempt to avoid paying for care. They have a rule for it. It is called Deprivation of Assets, and the consequence is that the home you've spent 30 years paying off can be counted against you when the care fees come. So David's £500,000 is not quite the simple victory it looked like on Tuesday morning. Today, we are going to work through what £500,000 actually delivers in 2026. Real cash in hand, each month after tax, and how to draw it down without accidentally handing the keys to your house over to the council. Let's start with a number that sounds generous and is in fact a problem. David's pension pot is invested. Let's say it grows at a modest 5% a year. That is £25,000 in annual growth. Add his state pension, £13,000, and on paper he has £38,000 coming in before he touches the capital. A reasonable income. A bit tight, but manageable. Except the tax picture looks nothing like that. Because of the freeze on the personal allowance, the state pension alone, £13,000, has already crossed the £12,570 threshold. That means David enters the 2026 tax year already a few £100 into taxable income before he has drawn a single penny from his pension. Every pound of drawdown is taxed from the first pound. There is no runway left. If David wants to live on £40,000 a year, which is what which now estimates a couple needs for a comfortable retirement in the UK, covering holidays, running a car, and replacing things when they break, he will need to pull roughly £27,000 from his pension on top of his state pension. That combination takes him close to £40,000 in total income, and somewhere in that range he tips into the higher rate band. At that point, HMRC takes 40 pence of every extra pound. This is not a fringe case. This is the ordinary maths for someone with a £500,000 pot in 2026. The mechanism here has a name: fiscal drag. The thresholds do not move. Wages go up, pensions go up, prices go up, but the tax bands stay fixed. So every year, more people quietly slide into tax brackets they never expected to be in. It is not that the rules changed dramatically. It is that the rules stayed the same while everything else moved around them. I have watched this happen to people who did everything right. They saved carefully for decades. They hit a number they were proud of. And then they drew it down the way their advisors suggested, or the way a comparison website laid it out, and found themselves paying far more tax than they had planned for, often in the first year of retirement. That is the frustration, and it is not your fault. The system was not designed for a world where the state pension nudges up against the personal allowance. That is a relatively new problem, and most of the standard advice has not caught up with it. So what does the real number look like? If David draws £27,000 from his pension on top of his £13,000 state pension, his total income is £40,000. After accounting for the frozen personal allowance, roughly £27,430 of that is taxable. At the basic rate of 20%, that is around £5,486 in tax. His actual take-home is closer to £34,500, not £40,000. That is a gap of £5,500 a year. Over a decade, it is the difference between a comfortable life and a quietly constrained one. The tax problem is real, and it is immediate, but it is only half of what David needs to understand, because the way he responds to it, which pot he draws from, in what order, at what pace, has consequences that reach well beyond his next tax return. That is what we need to look at next. There is a version of retirement planning that made reasonable sense about 7 years ago. Interest rates were low, gilt yields were low, you put your pension into a drawdown portfolio, took a cautious 3.5% each year, and the maths more or less held together. Plenty of people built their retirement plans on that assumption. Some of them are still living by it. Then came September 2022. Most people remember the mini-budget as a political story. Kwasi Kwarteng, Liz Truss, the pound falling, the chaos. What got less attention at the time, but matters enormously for anyone drawing down a pension today, is what it did to gilt yields. UK government bond yields spiked sharply and stayed elevated. The era of cheap money ended, not gradually, but in about a fortnight. For drawdown strategies built in the low-rate era, this was a structural shift. Bonds that were supposed to stabilize a portfolio lost value quickly. Annuity rates, which had been poor for years, moved in the opposite direction. They improved significantly, almost overnight. The whole landscape of how do I turn a pension pot into a reliable income changed, and it has not changed back. This matters for David in 2026, because the strategy that felt sensible in 2018 or 2019 may now be the wrong tool entirely. Not because David made a mistake, but because the environment around him moved. And there is a second issue that sits alongside the rate question, one that is harder to talk about but impossible to ignore. The ONS publishes mortality data regularly. The numbers for someone aged 60 in 2026 are striking. A man who reaches 60 today has a meaningful probability of living into his late 80s. A woman, slightly longer. If both members of a couple make it to 60, the odds of at least one of them reaching 90 are genuinely high, higher than most people intuitively expect. What that means practically is this: David's £500,000 is not funding a 20-year retirement. It may need to last 30 years, possibly longer. 30 years of inflation, 30 years of energy bills going up, 30 years of council tax rising, 30 years of the NHS doing what it can, but not everything. The biggest risk in that picture is not a market crash. Markets recover. The risk that is hardest to plan for, and the one that does the most quiet damage, is drawing down too quickly in the early years, locking in a lifestyle at 62 that becomes financially unsustainable at 75. I have seen this pattern more than once. Someone retires at 60 with a reasonable pot, spends freely in the first decade because they are healthy and the world feels open, and then arrives at their mid-70s with far less cushion than they expected, right at the point when care costs start to appear on the horizon. The standard drawdown advice does not adequately price this in. It tends to assume a relatively stable withdrawal rate over time, when the reality for most people is that spending is uneven. It is higher early, travel, home improvements, helping children, and then it shifts. Later spending is less discretionary and harder to cut. Heating, prescriptions, mobility aids, care, that unevenness matters, and the tax system does not adjust for it. The historical record says this clearly. The biggest threat to a £500,000 pot is not a bad year in the markets. It is a strategy that ignores inflation, misreads longevity, and does not account for the tax drag quietly running in the background for 3 decades. So, when we talk about how much David can actually spend, we are not just solving for this year's income. We are solving for a 30-year cash flow problem, one where the rules can change, the costs will rise, and the tax thresholds may stay exactly where they are today. That is the real planning horizon, and it changes the answer considerably. Let me describe a situation that is more common than most people realize. A couple in their late 60s. They own their home, nothing grand, a 3-bedroom semi in the Midlands, worth perhaps £320,000. They have a pension pot between them. They are not wealthy by any stretch, but they are comfortable. They saved carefully, they did not spend recklessly, and they assumed that if things got difficult in old age, they would handle it. Then one of them needs care. Not a nursing home, not yet, just some help at home. A carer coming in twice a day. In parts of the southeast, that is already running above £1,200 a week. In the Midlands, somewhat less, but not by as much as you might hope. The local council assesses them, and because they have assets above the threshold, they are told they will fund their own care. Fair enough, they think. We have money, we will use it. But here is where it gets complicated. The council does not just look at what you have now. It looks at what you had. If you drew down your pension pot quickly in your 60s, on holidays, on helping your children with a deposit, on finally doing the kitchen, the council may decide that spending was not ordinary living. It may decide you reduced your assets deliberately, in a way that was designed to avoid care fees, and if it makes that determination, it can treat you as if you still have the money, even if you do not. This is the Deprivation of Assets rule. It has been part of the Care Act framework for years, but it has become more actively applied as local authority budgets have tightened. Councils are under real financial pressure. They are looking more carefully at financial histories, and the threshold at which they begin scrutinizing past spending has been getting lower, not higher. I used to think this rule was only relevant for people who were obviously trying to game the system. Large cash gifts to children right before going into care, that sort of thing. After looking more carefully at how councils have applied it in recent years, I realized that view was wrong. Ordinary spending, if it looks accelerated or pattern-based, can attract the same scrutiny. This is the paradox that David, and anyone with a similar pot, is sitting inside. His pension is large enough that he does not qualify for means-tested benefits. He is above the threshold. On the other hand, if he spends it the way most drawdown advice suggests, he risks having that spending counted against him later. He is not rich enough to be indifferent to care costs, and not poor enough to have them covered. He is caught in the middle, what you might call middle-class limbo. The standard advice does not solve this. It was not designed to. Most drawdown guidance is written to optimize income and tax. Does not factor in the care cost system, because the care cost system sits in a completely different part of public policy, administered by completely different bodies. The two systems were not built to talk to each other. David, sitting with his £500,000, does not need to choose between enjoying his retirement and protecting his home. But he does need to understand that those two things are not automatically compatible under the current system. Getting the structure right is what makes them compatible. That is the work. And it is not as complicated as it sounds, once you see the shape of it clearly. Let's move the clock forward. David is 78. He and his wife Margaret have managed their drawdown reasonably well. They took holidays in their 60s, helped their daughter with a deposit, kept the house in good order. Life has been, on balance, good. The pension pot is smaller now. Not alarmingly so, but meaningfully reduced from the original £500,000. Then Margaret has a fall. Nothing catastrophic. She recovers. But the fall reveals something the GP had been watching quietly for a while, some cognitive decline, some difficulty managing alone. The family has a conversation. Everyone agrees she needs support at home. A carer in the morning, a carer in the evening. Someone to help with meals, with medication, with getting around safely. That is not a dramatic care scenario, that is an ordinary one. And in 2026, according to Age UK, the average cost of in-home care in the southeast of England has crossed £1,200 a week. In other parts of the country the figure is lower, but not by enough to change the underlying problem. £1,200 a week is £62,400 a year. That is not a care home. That is not round-the-clock nursing. That is 2 carers a day coming to the house. Now hold that number next to what David's pot looks like at 78. If he drew down at the pace most standard plans suggest, £30,000 to £35,000 a year through his 60s and early 70s, there is a real possibility the pot is sitting somewhere between £150,000 and £200,000 at this point, perhaps less if markets had a difficult stretch. At £62,400 a year in care costs, that remaining pot is gone in 3 years, possibly 2, and at that point the council steps in to assess. They look at the house, they look at the financial history, and if the drawdown pattern from David's 60s looks, in their assessment, like asset reduction rather than ordinary living, the deprivation of assets question comes back, not as a theoretical risk, as a letter. This is the scenario that most retirement income conversations simply do not reach. The focus tends to be on the early years. How much can I spend at 62, at 65, at 67? The later years, the care cost years, get treated as someone else's problem, something to revisit when it happens. But by the time it happens, the options are much narrower. The structure David needed was a buffer, a ring-fenced portion of his savings that was never drawn down for lifestyle, never transferred to family, and never touched in a way that could later be characterized as deliberate asset reduction. In practice, an ISA holding of £80,000 to £100,000, kept intact through the 60s and early 70s, gives a household genuine options at 78. It covers care costs without immediately triggering a council assessment. It buys time. It keeps the house out of the conversation for longer. That is not a luxury reserve. That is a structural necessity, given what care now costs and how the means testing system works. There is also a third option worth knowing about, even if it does not suit everyone. An immediate needs annuity, sometimes called a care annuity, is a product you can purchase at the point care is needed. You hand over a lump sum, and in return you receive a guaranteed income specifically to cover care costs for life, tax-free. The pricing depends on age and health, and it is not cheap. But for someone in their mid to late 70s who needs certainty around care costs without selling the family home, it can be the piece that holds everything else together. The point is not that everyone needs to buy one. The point is that having the option requires having the capital still available at that stage. If the pot has been drawn down to a level where there is nothing left to convert, the option disappears. This is what the 30-year horizon actually means in practice. It is not an abstract planning concept. It is the difference between Margaret getting the care she needs at home, in a house she has lived in for 40 years, and the family having a very different conversation at a very difficult moment. The money does not need to be hoarded. It needs to be positioned. Most people think about retirement income as a single tap. The pension pot is there, you turn it on, money comes out. The question is just how much. The order in which you draw from different pots is at least as important as the amount. Get the sequence wrong and you pay more tax than you need to, expose more of your assets to care cost assessment than necessary, and reduce your options at exactly the point in life when you need them most. There are 3 layers. They are not complicated, but they need to work in a specific order. Layer 1 is the ISA. If David has built up an ISA over the years, and many people his age have, particularly if they have been saving since the early ISA days, this is the first place to draw from in retirement. ISA withdrawals are tax-free. They do not count as income. They do not push him further into the higher rate band. They do not interact with his state pension in a way that creates a tax problem. Drawing from the ISA first does something else that is easy to miss. It preserves the pension pot for longer, and the pension pot, under current rules, sits outside his estate for inheritance tax purposes. Every month that money stays inside the pension wrapper, it is structurally protected in a way that cash in a savings account is not. This is layer 1. Use the ISA as the bridge. Keep the pension intact for as long as the ISA can sustain the income gap. Layer 2 is the pension. drawn through what is called a phased UFPLS, an uncrystallized funds pension lump sum. The name is unwieldy. The logic is straightforward. Rather than taking the full 25% tax-free lump sum in one go at the start of retirement, David takes smaller withdrawals from his pension periodically. Each withdrawal carries a tax-free component. 25% of each payment is free of tax, and the remaining 75% is taxable income. By spreading this over time, he keeps his total taxable income in each year below the higher rate threshold. He uses his personal allowance more efficiently. He does not spike his income in a single year and hand a large chunk to HMRC unnecessarily. To put a number on it, if David takes £16,000 from his pension in a given year via UFPLS, £4,000 of that is tax-free and £12,000 is taxable. Combined with his state pension of £13,000, his total taxable income is £25,000. That keeps him well within the basic rate band. He pays 20% on the amount above the personal allowance, roughly £2,486. His effective tax rate on that £16,000 pension withdrawal is around 15%. Compare that to taking £27,000 from the pension in the same year. His total taxable income rises to £40,000. He begins paying 40% on the slice above the higher rate threshold. The tax bill increases significantly, and for no additional benefit in actual spending power beyond the short-term cash in hand. That is a saving of roughly £3,400 in tax in a single year. Repeated annually, that is 2 Mediterranean holidays, or a year's worth of energy bills and council tax combined. It is not a marginal difference. Layer 2, then, is the phased pension draw. Small, regular, structured to stay within the basic rate band as long as possible. Layer 3 comes later. Around the mid-70s, when income needs may shift and care costs begin to appear on the horizon, it is worth considering an immediate needs annuity or a similar guaranteed income floor. Not for everyone, not necessarily now, but as a planning concept, the question to ask is this: at what point does certainty about income become more valuable than flexibility? For many people, that point arrives somewhere between 74 and 78. At that stage, locking in a guaranteed income stream, one that covers the baseline costs regardless of what markets do or what care requires, provides something that a drawdown portfolio cannot, a floor that does not erode. The three-layer structure, then, is ISA first, phased pension second, guaranteed income floor third. It is not a rigid formula. Life does not run on a formula. But the underlying logic: preserve tax advantages, stay out of the higher rate band, ring-fence capital for care, applies to almost everyone in David's position. David did not need to earn more. He did not need to save more. He needed to change the order. That single shift, drawing from the ISA before the pension, taking pension income in smaller phased amounts rather than large lump sums, saved him £3,400 in tax last year alone. The pension pot is lasting longer. The ISA is drawing down as planned, and the house is still not in the conversation. That is the whole point of the structure, not to be clever about money, just to keep what you have already earned. There is a particular kind of anxiety that does not get talked about much in retirement planning conversations. It is not the fear of running out of money exactly. It is something adjacent to that, and in some ways harder to shake. It is the feeling that if you do not spend now, while you are healthy and mobile, and the world is still open to you, you will have left it too late. That the careful, structured approach, the ISA bridge, the phased withdrawals, the ring-fenced buffer, is just another way of deferring a life you have already deferred for 40 years. That feeling has a name in the research. It is sometimes called one more year syndrome. The idea that there is always one more reason to wait, one more threshold to hit, one more risk to hedge against before it feels safe to actually live. I recognize that feeling, and I want to be clear, it is not weakness. It is not irrationality. It is a completely understandable response to a pension system that has changed multiple times in the last decade, a tax environment that keeps shifting, and a care cost system that nobody fully explains until you are already inside it. When the rules keep moving, caution feels like wisdom. Sometimes it is, but sometimes it tips into something that costs you differently, not in money, but in time. The reframe that I have found useful is this: the money is not disappearing, it is not being hoarded, and it is not being wasted, it is moving. From one pot to another, from one purpose to another, at a pace and in an order that keeps it protected. The ISA is not a locked box. The pension is not untouchable. The structure exists so that the spending can happen, just in a way that does not create problems you cannot undo at 78. Calling it a withdrawal strategy makes it sound like restraint. It is not restraint, it is sequencing. David is not spending less than he planned. He is spending from the right place at the right time. The holidays are still happening. The kitchen got done. He helped his daughter with her deposit. None of that changed. What changed is that when those things happened, they came out of pots that could absorb them without triggering a tax spike or a care assessment problem. The anxiety around money in retirement is real, and it deserves to be taken seriously. But the goal of all of this is not a larger number on a statement. It is a specific kind of freedom, the kind where you are not lying awake at 3 in the morning, wondering whether spending on a holiday last year is going to be used against you in a council assessment in 10 years' time. That is what the structure is for. Not to restrict the life, to protect it. So here is where David ends up. Same £500,000, same state pension, same tax system, but a different order of operations and a meaningfully different outcome. ISA drawn first, keeping taxable income low in the early years, pension drawn in phased amounts, staying within the basic rate band, with 25% of each withdrawal tax-free. A buffer kept intact for care costs, clearly documented as such, sitting outside the deprivation of assets risk zone. And a guaranteed income floor as an option, ready to consider when certainty starts to matter more than flexibility. Tax lower, house protected, life funded. That is the Care Shield structure. It is not a product. It is not a formula that works identically for everyone. It is a way of thinking about the order and shape of retirement income that accounts for the tax system, the care cost system, and the longevity reality of 2026, all at the same time. If you have a pension pot in this range, and you have not yet looked seriously at how these three systems interact, that is the place to start. Not because something has gone wrong, but because the decisions you make in the first few years of retirement are the ones that are hardest to reverse. If this has been useful, please subscribe. There is more to cover: the autumn budget changes, what they mean for pension IHT, and how the rules around gifting interact with the care cost system in ways that catch a lot of people off guard. And if you have a question or a situation that looks a bit like David's but not quite, leave it in the comments. I will read them. That is not a figure of speech.